Hi folks, welcome to another session of Investment Income for Life. United Hampshire US REITs announced another set of stellar half-year results. Its gross rental increased 13.3% while net property income increased 14% relative to its prior first half period of FY2022. It has also successfully improved committed occupancy for its groceries and necessities properties to a record high of 97.9%, with new and renewal leases totaling 331,000 square feet being signed in the first half of FY2023. At the price of US $0.42 per unit as at August 11, 2023 and a distribution declaration of 2.65 cents per unit, REITs is effectively giving out an annualized distribution yield of 12.86%, and this is notwithstanding an amount of US $1.5 million being retained by its management for asset enhancement initiatives. The distribution yield would have been even higher at 13.86% if all of it are marked for payout. Congrats to all fellow current unit holders who have been taking market risk to hold on to this US REITs. Hi folks, before we proceed further, please do me a favor. Help to click like and subscribe in order to support the making of more of such contents. Thank you. Quick review of the detailed financial results for first half 2023. As aforesaid mentioned, the net property income has increased by 14%. However, the finance cost has went up by a whopping 72.7%, which thus dragged down the overall net income before tax and fair value changes by minus 1.4%. One point to note here is that for fair value changes to investment properties or financial derivatives, these have no effect on the cash flow and distribution payout unless they are realized. From the financial statements, there are actually two key risks that one should take note of and which I will elaborate further in the final portion on the final section later on. Next, let's look at the debt profile status of REITs. REITs has no major refinancing exercise coming up until November 2026. For 2024, there is a small tranche of US $21.1 million of mortgage loan maturing only. Moreover, 80.9% of its debt are fixed interest at a weighted rate of 3.57%. Aggregate leverage is at 42%, which personally to me is on the high side. We will discuss further on REIT's planned disposal of Big Pine Center in the next section on how this would help repay part of its debt to bring down this leverage ratio. The REIT's manager has entered into an agreement to divest Big Pine Center, Florida, for a sale consideration of $9.9 million. The consideration represents a 3.7% premium over the December 31, 2022 appraised value of $9.5 million and 7.7% premium over the purchase price of $9.2 million. Assuming the net proceeds are used to repay debt, REIT's pro forma gearing is expected to be reduced by 0.8%. Next, the million-dollar question on REIT's investment properties outlook that everyone is wondering. Will REITs go down the road of Manulife US Office REITs or Prime US Office REITs? Interestingly, the Green Street Property Price Index indicates that the remote work-from-home arrangement post-COVID pandemic, which severely affects US office commercial properties, actually benefited the strip center sector, which is the key properties held by REITs. Apparently, workers working from home increased the demand for the goods and services offered in strip centers. From June 2020 to June 2023, the valuation of Stripe Center increased 19%. Similarly, self-storage properties valuation went up by 58% over the past 3 years, and that it is also one of the type of commercial property held by REITs, albeit making up a small proportion of REITs' portfolio. Last but not least, this is my parting thoughts. There are two key risks faced by local unit holders of REITs. Number one is the forex risk arising from weakening USD due to widespread money printing by the US Federal Reserve. The second key risk will be the high aggregate leverage ratio of 42%, which makes it susceptible to breaches of bank loan covenants that automatically lead to loan default should there be structural headwinds in demand or from higher interest rates hikes in the event that the inflationary monster comes back. In addition, the structural setup of UH REITs seems to be eerily similar to Manulife US REITs, which leads to a further question on whether rights issue to all unit holders as a last resort to raise funds is actually feasible in the event of a debt crisis. According to Manulife US REITs, this rescue option cannot work as each unit holder can only hold up to 9.8% of units in such a setup, and the sponsor are thus unable to step in. This render having a reputable and financially strong sponsor as good as useless. I will probably be sending out queries to the investor relation team of UH REITs to find out more. That is all for today, folks. Have a great week ahead.